Hello guys, welcome back. In this video session we want to run some analysis looking at possible point of interest to select a setup from. Now basically the asset class we want to analyze extensively is volatility 50, and we want to look at the general market knowledge with regards to the information we have on this chart, ranging from liquidity, ranging from market structure, and also understanding the narrative. That is the concept of internal and external range liquidity. So let's get down to business. With me here is volatility 50. Now let's go to the monthly time frame with regards to what we're seeing. Now based on the information we have over here, you can see volatility 50 is doing nothing but selling to the downside. You can see over here we had a situation where the market broke the all-time high over here and then dropped. It has been dropping so far for the past 6 months, right? And that has caused nothing but a break of market structure to the downside, breaking all levels and disrespecting all bearish point of interest. So basically this speaks volumes in the sense that this gives us the understanding that the market is bearish in this case with regards to this idea we're seeing on the monthly time frame. So head into the weekly time frame. What do we have on the weekly time frame? You can see likewise the market is selling to the downside, right? On this side we have just the information we had is a situation where the market tapped into this order block range over here and then the market dropped to the downside, right? So let's mark out that order block that the market tapped into. The market tapped into this order block range over here, sold to the downside. Now basically in the long term we can expect maybe probably the market can dip into this order block range over here too and then sell to the downside. So let's mark that order block range out. So we want to see to it that if the market can come into this level and drop to the downside, we would like to participate. But mind you, the market might not really come into this point because it's long, right? The movement has been long. But there's a possibility that the market can tap into this breaker block. Now look at this. We have a breaker block like formation inside this level. 1, right? 2. So as I said, how do you use breaker blocks? Basically breaker blocks, you want to use them in a selling market. Two things can happen, right? Is either the market respects the neckline of the breaker block and sells to the downside, or the market goes deep and then sells. So there's a tendency the market can respect that neckline over here, right? So basically we can care about that neckline, this level to this level. We want to see how, if the market comes into that level, will there be a possible reaction from that neckline. So it's definitely something we care about. So we can even just take out a line. No, let's take out a shaded area, mark this level, right? And we want to see how the market reacts when it gets to this point. So this is the nearest point of interest we're having on the weekly time frame. So let's go to the daily time frame for more trade ideas. On the daily time frame, what do we have on the daily time frame? Of course we're expecting maybe, probably, right, the market can come into this point, right? It's all a game of probability. The market can decide not to come back. It happens. But look at the basic concept of what happened over here. Now let's look closely. The market dipped a little bit, broke structure to the downside, right? Took out this low, which is a major low, right? In this case, an external range liquidity. Now when the market takes out external range liquidity, what do you expect? I always say this: when the market takes out external range liquidity, mind you, external range liquidity is nothing but a high or a low, right? When the market takes out a major low, you expect some sort of retracement into internal range liquidity, right, before the market continues to the downside. And I told you internal range liquidity most of the time is nothing but fair value gap. Internal range liquidity is fair value gap, right? And you can see in this case the market tapped into this fair value gap range over here after breaking this level, right, and then dipped into the fair value gap and kept on selling, right? So once again the market broke this level, which is an external range again, right? External range liquidity was broken. What do you expect? So you expect the market to tap into some sort of internal range before the selling activity continues. So based on this, let's draw our Fibonacci retracement tool. We want to give you from the high to the low, right? Let's draw it out. That is the nearest recent dealing range we can see. So we have this dealing range. We have level 38.2 over here, which is where we always expect at least the market should hit when we're having a retracement, right? And we have level 5.0 at this point, right? Level 50. And now basically we expect that discount price range should be at level 50. So most likely we want to see in a situation where if the market gives us a confirmation entry on lower time frame, we want to see to it that the market at least pushes deep into this fair value gap range, right? But what we have over here is preferably now we would want to see the daily candle for today closing like this, and then when the new candle opens, there would be a fair value gap we can expect the market to dip into. Okay, so mind you, the first line is 38.2, the second line is 50, right? That level 50 is the equilibrium point where we expect at least the market will tap into before it continues to the downside. Sometimes the market will not do that, it will just tap into the 38.2 level and keep on dropping, right? So based on that, let's go to the 1 hour time frame. On the 1 hour time frame, what do we have? On the 1 hour time frame, you can see over here we had a situation where the market gave us a change of character. The market broke structure to the upside, right? And since we're expecting at least the market will go into internal range liquidity at least this level or this level, there is a possibility for us to look for a buying opportunity down here, right? Because the market took out external range and now we're expecting the market to move to internal range. That gives us a narrative in the sense that we have an understanding of probably what the market is going to do. Mind you, the market does two things, okay? The market always takes out stops at an external range liquidity, which is going to be a low or a high in a buying market, right? The market will always take these levels out, and when it takes it out, there's going to be some sort of retracement deep into the range before the buy activity continues or before the sell activity continues. This is how the market algorithm works. The deep retracement is to enable the market dip into internal range, which is a fair value gap, and then drop to the downside. And the sole reason in terms of liquidity for this is most of the time when the market takes out a low, we have traders who will now want to start looking for a selling opportunity immediately when the low is taken out. And if you want to sell, this is not a premium price range for you to sell at, hence making that level low probability. So what the market does is the market will liquidate this point that has this low probability entry selling opportunities, right? The market will liquidate it deep into equilibrium, right? Or premium pricing before the selling activity continues. So you can say the market pushing into internal range liquidity is some sort of liquidation that the market is trying to do, right? Let me explain again. If the market takes out a low, external range liquidity is taken out, right? A low or a high is external range liquidity. Now, as I said, we have some retail traders who will want to start looking for selling opportunities when a major low is taken out. Example, you'd want to see a retest to continue, right? Now, if you draw your dealing range of Fibonacci retracement tool from the high to the low and you discover that this level is not at a premium price range for you to sell at, this level is low probability. And most of the time, the market targets these levels because it knows traders will want to sell over here. If it is not high probability, the market will end up reading this level, taking out the stops over here before it continues to the downside. And likewise for a buying market, if the market is buying, you expect the market to take out external range, which is a high, and most likely when that level is broken, we have traders who most likely will want to start buying immediately from that point. But if you draw your dealing range from the high to the low, you will discover that maybe that level is not a discount price range for you to buy at, and hence most likely the market will end up liquidating these traders over here, pushing to the lowest end of this range, and the market will most likely continue to the upside, right? So basically this is just a schematic example of how these things occur, right? And an example which I can give you on the daily time frame, let's go to the daily time frame with regards to this example I'm giving you over here is, look at this, the market took out this low, right? Now, as I said, when the market takes out a low, or let's use this recent point over here, right? The market takes out a low. Now, when the market takes out a low, let's use the recent one, right? If the market takes out a low, the market knows traders will start selling below, right? Now, the selling opportunity will only be high probability if from the dealing range that has been created, the selling zone you want to take is at a premium price range. So, let's mark out our Fibonacci retracement tool from the high to the low, right? So, from what you're seeing over here, you know that a high probability setup will form, a selling high probability setup will only form when the market hits 50%, right? So moving to the 1 hour time frame, On the 1 hour time frame, that means any setup that forms here, this is low. This is not a premium price range. That means the setup that forms here is going to be low probability. And this is what the market wants. The market wants to trap traders. We indeed know the market structure is bearish. But since we have a level like this, and from drawing your higher time frame dealing range, you see that this level is not at a premium price range to sell. If you sell over here, you're going to be messed up. And this is why sometimes you will be in the right side of market structure and you end up losing. Because of stuffs like this, you have to take note of the dealing range and you have to understand the concept of internal to external range liquidity. It's very important. Get the law. Whenever the market takes out external range liquidity, the market will most likely retrace into internal range. Internal range is going to be a fair value gap. In a selling market, you'd want the market to tap into an equilibrium or premium fair value gap range. Equilibrium is just 50% of the range. Just divide the range into two. Okay, the market will most likely hit equilibrium before it continues. So anything that will most likely form over here is low probability. So you have to put that at the back of your mind. And that is why this is low probability, right? And most likely this might also be low probability because it's yet to hit level 50, right? So that is why we know, that is why you have to understand the smart money concept. We that know that, okay, this is what the market is trying to do to traders. That is why we want to buy over here. Reason being, we know that the market is planning to destroy traders who are going to sell over here, right? That is what makes this level high probability. So if the market comes into this point, we have a potential opportunity to see that we want to buy at least to 38.8 level, right? That is price level 141.2373. Okay, so this is just a schematic example with regards to understanding this internal and external range liquidity. We discuss this day by day, right? And this is our point of interest based on what we've discussed and the factors we've seen with regards to liquidity, right? So this is just a schematic chart example with regards to general market knowledge and factors to consider when selecting your point of interest. Okay, so just wanted to give you insight with regards to this one, guys. I hope this video session was insightful. It's a short one, right? I make this kind of videos day to day. We just select a chart, analyze them randomly, sharing general chart knowledge. Okay, so this is just the concept with regards to what I have for you. I hope this video session was insightful. Until next time, I wish you good luck and good trading.